during the negotiations, we included what I would call a COVID clause in the purchase, where the seller had to maintain a minimum of an 85% economic occupancy from the day we put the property under contract to the day that we closed, in order to make sure that the property remained stable during the due diligence period. So we wrote that in there. Of course, if he wasn't able to maintain that economic occupancy, then we would have been able to back out of the deal, which we didn't intend to do or want to do. But if things got worse during the 60 to 75 days from the day we put it under contract to the day we closed, then we would have had an ability to exit the contract with no penalty.
Or
so that was
renegotiate the
one
price as
term.
well, right? Like you would have been able to renegotiate because now that the occupancy was less, the income was less, and then that affects the price.
100%. We would have been able to renegotiate from a much stronger standpoint, with having all of our at-risk money refundable back to us very easily in that case, versus having the money at risk being, the seller would have a stronger place if we didn't have that clause in the contract. So we had that, first of all, before we even closed. Second of all, after we did close, we closed in the middle, towards the end of October, which in the Midwest is a very bad time to be closing because leasing is almost stagnant during the holidays. People don't move when there's snow on the ground. Mm-hmm. So leasing was very slow for the initial period. We also find that in workforce housing, a lot of tenants choose to buy Christmas presents as opposed to paying rent during the holidays.
Welcome to Real Estate Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here's your host, Anette, Talie.
Welcome to another episode of Real Estate Deal Closers. I am your host, Anette, Talie, and my guest today is Lee Fjord. Welcome, Lee.
Thanks, Annette. I really appreciate you having me on. I'm looking forward to bringing some value to your audience.
I can't wait. But before we start, let me tell you guys a little bit about Lee. He started in real estate in 2012, building a property management business from 20 doors to 220 doors in 4 years. He relocated to St. Louis and began investing in a duplex and continued to purchase investment property until he found the power of partnerships, and he was able to close on a 38-unit apartment complex near St. Louis in 2019. The same team closed its first syndication 506B of 76 units in St. Louis in 2020, right in the middle of COVID. He focuses on larger multifamily properties, value add, and his company, the Green Forest Capital's mission is to provide safe, clean, and modern affordable housing to thousands of workforce families throughout the Midwest and Southeast, providing an above-average return on investment to his investor partners. So, Lee, tell me, how did you get into real estate?
Thank you. I got started by being a residential real estate agent that wasn't very good at sitting open houses or selling houses. So I thought I was going to be the world's best residential single family sales agent, and I got my real estate agent license, went to sell some houses, sat open houses for 6 months and realized that no one was just going to walk in and buy it. So I ended up being offered the ability to take over the management department of the brokerage. It had 20 houses at the time. And over about 4 years, I built it up from 20 to 220 and learned a lot of lessons from my clients in building that property management company up.
Amazing. So that's what sparked your interest, seeing other people managing or managing properties for other people.
Precisely. Yeah, I learned a lot of lessons with other people's money, and it was a wonderful experience learning from the bottom.
And we have that in common. So I also started managing properties and, learning from an owner that had many properties, learning to manage, and then bought my first property. And I can say that was the best way because I was being paid to learn investing. So it was amazing. So that's cool. And, your company, Green Forest Capitals, has a special mission, and you have, you invest, but you also do. Explain to us what's the mission do you have?
Yeah, so we invest in workforce housing, and we also donate 1% of the proceeds from our company to the reforestation of our national parks. So 1% of the distributable proceeds is donated to an organization called One Tree Planted, and they plant a tree for every dollar we donate. And our goal is to plant 1 million trees in the next 10 years.
Amazing. Love the mission.
The Deal.
All right, so let's get into the deal. What deal are we going to talk about today? Where is it located, and what type of asset?
We're going to talk about the 76-unit syndication that my team and I closed in October of 2020. It's a 76-unit complex built in the mid-1980s in a northern suburb of St. Louis called Spanish Lake. It is all 2-bedroom, 1-bathroom, 800 square foot, all electric apartments. And we are going to execute a value add refi and roll business plan on that property.
Amazing. So tell us a little bit of how did you find this deal?
The deal was brought to me by a colleague of mine and the sellers who knew the seller would be interested in entertaining offers. He is a real estate investor here in town as well, who primarily focuses on wholesaling single-family houses and small apartment buildings. He knew that the seller would be interested in selling the property, so he brought me the deal and said, "Hey, would you be interested in offering on this property?" And I took it upon myself to, move forward with the property tour, underwrite the deal, and took it from there. So
that is awesome.
It pays to make friends with a lot of people.
Yeah. So I was going to ask you, does it pay to be a realtor? Because you got this connection from another realtor.
Yeah. Originally, we met through a real estate investing networking group, and he was introduced to me through a friend, and it was a great experience. So he's not a realtor, and he didn't receive a commission on it, but he did receive a referral fee. So the seller paid him a referral fee to introduce the two of us, and he was very happy to receive it.
That is awesome. And that is so true. And probably you also shared with him what you were looking for. And so that stayed in his head. And when he saw this deal, he was like, oh, maybe Lee is interested in it. So, to the listeners, make sure that you're sharing with people what you want, the deals that you are looking for, and being a little bit specific on your niche and the size, so that when your connections see something like that, you are top of their mind, and then they can call you. Cool. All right. So, was there a listing price? Because this was an off-market deal. So what was the initial price, and were you able to negotiate it?
The seller had a number in mind, and when he provided me with the books and records and the rent roll for the property, I made an offer through a letter of intent. We negotiated back and forth. I believe his original asking price was 3.8, and we ended up negotiating a purchase price of 3.6. which was then retraded after inspections down to 3.57. In my initial offer, I also included that I wanted $150,000 in seller financing. So we also achieved we received a small portion of seller financing that helped contribute or reduce the amount of money we had to raise in order to close the deal.
Amazing. So this is a very creative deal, because not only you were doing a syndication, but you were also doing seller financing on the deal. Awesome. And so from my calculation, it was about $50,000 per unit, the initial price, but you ended up getting it for less, right?
Absolutely. Yeah, we got it down to 47 and a half a door after the negotiations and after the retrade during physical due diligence.
Yeah, and so what type of items did you find on your due diligence that you were able to negotiate this so that people understand what they have to be looking for?
There were two major issues with the property that we discovered during physical due diligence. First of all, we found that the air conditioners and furnaces throughout the property, a large portion of them were original in age. So they were approaching, 35 years old, many of these units.
Mm-hmm.
So when we took that to the seller and explained to him that we are going to be facing a huge amount of capital expense over a very short period of time as those units are taken out of service due to their age, he was willing to negotiate the value down or the cost down on the purchase by about $50,000. And then we split the difference. We originally said we were going to do 60. He and I agreed on 30. So we ended up, agreeing to a $30,000 reduction. We also discovered that the roofs were at the end of their useful life due to the fact that they were damaged heavily by a hailstorm while the seller owned the property. So we ended up taking that to the seller's insurance company, and the seller processed or moved forward with an insurance claim on the roofs and assigned the roof claim to us as the buyer. So when the roof claim was approved and funded, the seller assigned the funds to us as the buyer for the future replacement of the roofs. So in a sense, we end up with a new roof on our property, and the seller ends up being able to sell the property. So it doesn't cost him anything, and it doesn't cost us anything, but we end up with all new roofs, all new gutters, all new downspouts, and the hail damaged 25 of the air conditioners at the property and siding on 2 of the properties. So it was a multi-six-figure insurance claim.
Amazing. That is such a great idea you just gave me, because I am looking at a property that, I know the roofs are at the end of the life, and I think we had a couple of storms. So, if you can prove that the damage was based on these storms, you may be a claim. It may be a claim waiting to happen. Amazing.
Absolutely. Yeah. It's one of my go-to statements is never be afraid to ask for something you want, because you just might get it.
Absolutely. I totally agree with that. And I think a lot of times we ourselves say, no, it's not going to happen, and we don't do it. So we have to be bold and just ask, like you said. All right. So let's talk about the financing, because that's kind of like the tricky part. Yeah. How did you structure? What type of terms did you get on your loan? Yeah. And, it seems it was a larger loan, so you probably went with agency, but maybe you did some bridge loan. So tell us a little bit about your financing. Yeah.
We went to my local regional bank that closed my previous deal, and we ended up getting an 80% loan to cost loan on the property. The property was stabilized over 90% occupied for the last 90 days. So we were able to get an 85% loan. We also got a construction loan for $250,000 from the regional bank. The term of the loan is for 5 years, 2 of which are interest only. And the rate was 4.25%.
Amazing. Wow. So that's
and no prepayment penalty. That was the kicker for that. No prepayment penalty.
That's the best. I think that's, especially right now, the rates are so low. If you're able to stabilize the building right away, you can refinance on low rates, because you don't know what's going to happen in 5 years. So if you get stuck, I was looking at actually rates today, and there were like a couple of options. One was 3-year prepayment penalty. The other one was 5. So I was like, no, I rather do the 3-year because, it's a step down. So, 3 to 1, then you, even if you do it on the second year, you're paying less penalty. Very interesting. So how did COVID play into this? Because I am assuming closing in the middle of COVID, threw some curveballs to you and your team.
Absolutely. First of all, we had, during the negotiations, we included what I would call a COVID clause in the purchase, where the seller had to maintain a minimum of an 85% economic occupancy from the day we put the property under contract to the day that we closed, in order to make sure that the property remained stable during the due diligence period. So we wrote that in there. Of course, if he wasn't able to maintain that economic occupancy, then we would have been able to back out of the deal, which we didn't intend to do or want to do. But if things got worse during the 60 to 75 days from the day we put it under contract to the day we closed, then we would have had an ability to exit the contract with no penalty.
Or
so that was
renegotiate
one
the price as
term.
well, right? Like you would have been able to renegotiate because now that the occupancy was less, the income was less, and then that affects the price.
100%. We would have been able to renegotiate from a much stronger standpoint, with having all of our at-risk money refundable back to us very easily in that case, versus having the money at risk being, the seller would have a stronger place if we didn't have that clause in the contract. So we had that, first of all, before we even closed. Second of all, after we did close, we closed in the middle, towards the end of October, which in the Midwest is a very bad time to be closing because leasing is almost stagnant during the holidays. People don't move when there's snow on the ground. Mm-hmm. So leasing was very slow for the initial period. We also find that in workforce housing, a lot of tenants choose to buy Christmas presents as opposed to paying rent during the holidays. So we had a period of time where collections were difficult. In addition to COVID, in addition to people not having a recent stimulus check to be able to make their payments, but you adjust as needed. Luckily, we have been successful at getting access to federal stimulus funds by applying for our tenants on their behalf or with their help. Of course, we apply together in order to have their back rents be subsidized by the government. The recent, I think it was $25 billion stimulus package that was assigned specifically towards, or portion of the stimulus package that was assigned towards rent payments, was hugely beneficial to us. So, or has been slowly and surely. Have we had payers or tenants that don't pay? Of course, but Yeah,
I mean, but I think that if you are a proactive manager, property manager, and then you help your tenants get the help, because a lot of people just don't want to do it, or they are intimidated by the process, and then they don't do it themselves. And you are not helping your case. We are going through the same thing. It's similar project in Ohio, which is also snow, and we acquired it in October. So, similar, and our filling up the vacancies has been a slower process than what we expected because of the same reasons that you are sharing. People don't want to move in December, November, while we have the snow. They also, we're waiting for more government money. They overspend for the holidays, and, you got to deal with that. You got to be proactive. Awesome.
Absolutely. Yeah.
Yeah, so definitely, if you are managing yourself, or if you have a property management company, make sure that they are proactive with your tenants. All right, so what is your exit strategy for this property?
So the exit strategy will be a refinance into long-term debt, specifically, as of right now, a Freddie Mac small balance loan. We bought the property stabilized, but there is a sizable amount of upside when we when we improve the condition of the unit. So what we do is, when we have a vacancy, we go in and we touch every surface. We paint the walls, we paint the trim, we replace the slab doors with 6 panels, we rip off the countertops, we put new laminate countertops down, we paint the cabinets, we bring in newer appliances. We generally go with like a black stove, black fridge, black hood range or hood, and we put in all new brushed nickel hardware, new vanity, new toilet. Those, we will update the condition and the look of the apartments. Then those apartments that are currently rented for about $675 on average, we're able to and have successfully leased several of the units for $830 a month. So there's about $150 rent bump there when we do those upgrades.
And
in addition to that, we'll be adding.
Yes.
In addition to that, we're doing amenity updates throughout the complex, adding a dog park, a playground, a grilling area, we're updating all the common area spaces, the stairwells, adding security lighting, add a security gate to the entrance of the property, seal stripe patch all the parking lots, doing a lot of things that beautify the complex, the roofs, of course, as well. Landscape updates. And then we also, when we go across the board and do our renewals, we're increasing the rents by about $75 per unit across the board as we do lease renewals. So we will force the value of the property up, and then we will refi or reappraise the property in about 24 months, 24 to 36 months. And then we will execute a refi, extract equity from the property, use that to pay off the construction loan, the seller financing, and buy out all of our limited partners.
Amazing. And, and just to give you an example on that $150 increase, that brings you around $1,800 per unit a year, which if you multiply what, the 76 units, when you're done with your renovations, it's a sizable amount of extra income that you're going to get. So you are, like you said,
Absolutely.
You're forcing that equity.
It should improve the value of the property by a little over $1 million.
Excellent. All right. Well, I am sure that it's going to be an amazing project, and congrats.
Productivity hack.
So now we go to the part of the show where you're going to share with us your productivity hack. And this is the one thing that you have implemented in your business that is taking you to the next level.
So I have two, actually. First of all, I have a daily planner that I carry with me everywhere I go, and it goes with me wherever I go. I use it to take notes. I use it for my appointments. I use it for my to-do list. It's called the Lion Planner. It's available on Amazon. I don't own any of it. It has nothing to do with it, but it's the best one I've found. I've probably spent hundreds of dollars on other planners that I've tried and they weren't as good. And then finally I found this one, and it's absolutely amazing. And it helps you build out a plan for yourself over an entire 6-month period in one planner. And it comes in 8.5 by 11, which is huge, as opposed to the little guy one that you can't really read and you're trying to scribble little notes inside of. In addition to that, Calendly. Calendly is just a game changer. That
Absolutely.
Being able to just say, hey, book a call with me and we can have a chat without working out the middleman or the issue of what time or who's going to call who or any of that mess, game changer.
Absolutely. The only tip I'm going to add to Calendly is make sure you plan your vacations ahead so that you don't get scheduled calls on your vacation. I had to reschedule a bunch of them because I forgot to put it on my calendar. And then I realized that people were booking and I'm like, oh no, I'm not going to be home. So yeah, but Calendly, definitely a game changer. Totally. I started with the free version and right away I started paying because it's just so valuable. You just lose the back and forth of coordinating meetings, which is amazing.
Expert tips.
All right, so now we're on the 3 expert tips segment, and Lee is gonna share 3 expert tips on how to find your perfect partner.
Absolutely. So I find that when you're looking to find a partner, the best place to look first is at yourself and what strengths and weaknesses you have. and specifically find partners who offset your weaknesses. Specifically look for someone who is either physically in a location that's a better location for investing, someone who has a higher balance sheet than you, or someone who has more experience than you, or if whatever you're lacking, find someone to fill that gap, because if you don't, it'll always be there. And if you partner with someone who's exactly the same as you, you're basically just having a conversation with yourself.
Yeah, and I think sometimes to add to it, sometimes you partner with people because you like them, because they are your friends and you get along, but that's not going to help you grow, because if they are the same as you know you're always going to have the same challenges. So you need to really that tip is amazing for sure.
Thank you. Absolutely. I couldn't agree more. The next one is find partners who are truly passionate about the goal, about your mission, about what the business plan is for that specific property. If they're not passionate about that property or about real estate investing or your business that you're doing together, because it's a business, if they're not passionate about it, they're going to lose interest, and then they are going to move on to something else. So find someone who is just absolutely passionate about it, and is just going to find that drive and going to work in the evenings and the weekends to get it done and make it happen.
100%. Totally agree. Nothing worse than partnering with somebody that won't pick up the phone when you have a decision to make, or an important thing to share, and then they are not available, and then you're stuck with waiting. They have to have the same passion and drive and really want to do it as much as you do. If you are laid back and that's the way you operate, that's fine. But if you are a go-getter and then you partner with somebody that really doesn't want to do it, then you're going to have that problem.
100% you will, every time. The last one is finding partners that are truly excellent at who they are and what their role is on your team, and be unrelenting about how you are looking for the absolute best of the best. Not only do they need to offset your weakness, but they need to be excellent at what it is that they do and their role and who in your team, on your team. So someone who is truly excellent at it, not just someone who thinks that they can do it okay or do it well, but somebody who's already excellent at that one particular thing or those things that their role covers.
I love it. I love it. And I find that sometimes we tend to just hurry up into a partnership just because we just want to partner with somebody and we want to have a team, and we don't look at these amazing tips that you shared, and then it doesn't work out, and then you have to start over. But if you follow these 3 amazing tips that Lee just shared, you're going to be in such a better position to grow and to get to your goals faster. So thank you so much for sharing. All right, so Lee, this has been amazing. Thank you for sharing so much knowledge with my audience. And please share with people where can they find you online, and your website, your social media.
Absolutely. So they can find me on Facebook. It's Lee Fjord, Fjord. I also have a website, greenforestcapital.com. That's my syndication company. You can book a call with me directly on the website. And I also have a Facebook group, a club that I recently started called the 100 Door Club. It's a club for owners of 100 doors or more already who have reached that level to gather and network and meet and see where they can add value into each other's lives. And also feel free to reach out to me any other way, Instagram, Facebook, LinkedIn, I'm on all of them.
I am super excited about your group. I'm going to go check it out. And I'm a big proponent of networking. So, joining groups like Lee's group is going to take you to the next level. You're going to start with any group, and then you're going to keep moving out the ladder to, once you start learning, and I started in a group, but it was at one level, and then they moved on to the next one, and keep networking with people that are doing what you want to do, so that you can, share the excitement and learn from them, and then eventually become friends and partner up. So, and if you join a group like the $100, then you're going to be partnering up with people that also have $100. So that's an amazing idea. All right, Lee, thank you for being here. And everybody, if you're enjoying this show and you like this episode and you learned something, don't forget to subscribe to the channel and to share this podcast with everybody. Thank you. Thank you, Lee.
Thanks, Annette.
Bye-bye.
Bye.
This was Real Estate Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.